Hello, equity traders, and welcome to the weekly market report. I'm AJ Monty, and this is a one-year daily candle chart of the NASDAQ ETF, ticker symbol QQQ. And as I do each and every week, I've left my lines on the chart so you can see how the forecast worked out. Now, I'm starting off with the Qs because this is the index that more or less had a mind of its own this week. And you can see on Monday, it formed this very significant bearish engulfing pattern. Tuesday, we bottomed out, bounced off of the 20-period moving average, hit the target that I set for last week. Remember, that was 285.56. So that would occur by the 12th, which was yesterday. I'm recording this on the 13th. But then it bounced. And now we have a slight upward move here on lower volume. Now, before I get into the other markets, let me just say that when you start to see such choppiness that we've seen over the past month, actually, that is a sign that the markets are starting to lose sight of a direction or trend. So the risk management principles that I promote are of utmost importance right now, especially if you're taking on any new positions. Now, this resistance area is going to hold in place, I believe, so I'm going to leave that there. I'm going to erase this, and I'm going to move out 5 days based on this drop in volume and that small little candle. I'm going to say we might see Monday and Tuesday a little bit of a rally, but then that is what's most likely going to happen as we pull back towards this moving average. Now, my end line target for the 21st of November is going to be 286.01, and that's the Qs. Now, let's take a look at the VIX. Again, this is very interesting what we're seeing here because the VIX made a move halfway up my target here on Thursday, pulled back, and it's now still hovering around this support level. I still think the VIX is going to move back to that 20-period moving average, so I'm going to erase these lines. I'm just going to move that out and draw it just like this, like that. Now, how do I get that angle? I look to the left of the chart, just like that. I draw an uptrend, capturing as much of this range as I can, duplicating that angle. Look, you'll see I do this over and over again so people can see how I'm doing my forecast. And then I drag it over. Look how close that is to the line that I just drew right there. So that's the length and the angle at which I think will pull back to that 20-period moving average on the VIX. Again, that target is going to be for December 1st. This is after Thanksgiving. I'm going out there a little bit further. I think that 29.29 will be the most likely target for the VIX. Now remember, the support level down here, we have two support levels. We have this longer term support level right around 21, and then we have this support level that seems to be holding just over 22. The oscillators, stochastics oversold, could start to turn up. The CCI is kind of floundering right there at the oversold condition of minus 100. But at any point in time, as soon as the price on the VIX starts moving up, this CCI will start moving up as well. Now, inversely related to the VIX is the SPY, which is the S&P 500 ETF. You can see this one did not work out. Just like that, it did not pull back. But notice the volume. We're starting to see that volume drop. So what I'm going to do is I'm still going to keep my targets lower on that for the gap fill. And I'm going to draw this angle back here. See this? I'm just taking more or less a conservative angle between this angle and this angle. I'm going to go with this one right here. Over a 5-day period, I'm going to duplicate that. Move it on over just like that. That should bring us back to the 20-period moving average. There's still a gap down here on the SPY that could be filled, but I think the 20-period moving average will be the most likely target for the short term. That is 345.56. Let's take a look at the IWM, which is the Russell 2000 ETF. You can see there's still gaps below the market. We did not go lower. In fact, we closed over this resistance point. But again, as I erase these lines, you can see I missed the target on that one, but that's okay. If you're long the market and the market continues to go up, there's no harm done. In fact, it's it's better that you put a stop below a key support level to protect yourself on the downside. But if it goes up, all you have to do is trail your stop up. Now what's happening now is this former level of resistance is coming very close to a roll reversal. So we could see something like this happen where the gap fills and starts to bounce. I'm using a two-part leg here on this forecast, but this is what could happen as we fill that gap. This, by the time the price gets out here, this moving average will more or less coincide with that price. So the pullback point, I'm going to give you two targets. The pullback point to that roll reversal is 164.26. And then the bounce target after that as we come into what may be the year-end rally, aka the Santa Claus rally, that's going to be December 3rd. Now let's go and take a look at the diamonds, ticker symbol DIA. This is interesting. We have a gap that stayed open all week. It did not even attempt to come back down. We gapped up on Monday. The news was Pfizer. Now interesting, if the news on Pfizer was so great, then why was Pfizer pulling back after the gap? There seems to be a lot of misinformation with regard to what actually drove the market up on Monday. It could be political tension, it could be political forecasting, it could be anticipating what the Fed might do as we come into the new year. There's a lot of different variables there, but the fact is this gap is still very much left open. That's going to act as a magnet to the downside. So I think we could see this pullback at least to this point and then maybe beyond. So I'm going to leave it just like that with my forecast for the diamonds at 286.12. Now I'm going to stay on the diamonds here for a second and show you why I'm so concerned about the downside risk. If I switch the diamonds to a monthly chart, just like that, and I zoom in just a little bit, this is higher highs right here. See the higher highs right there, followed by lower lows. Interesting, isn't that? That's known as a broadening pattern. Some will call that a megaphone top. Some will call that a broadening top. Now, most of the time, the broadening tops will take only a few weeks to form. This one, of course, based on the monthly chart, is showing quite an impressive broadening effect here. And there is a risk that we could start breaking out below that 20-month moving average. That's number one. Number two, as the highs are getting higher, look what's happening to the CCI. The highs are going much lower. Now we saw that happening right before the major crash in 1987. We saw that before the crash in 2000. We saw that right before the crash of 2008. And now we're seeing it again. So that's why I'm leaning more towards the sell side. Now remember what I said before. This is a textbook trading pattern right here. See this? This is, again, just a diagram taken from Metastock actually, so compliments to them, on what a textbook megaphone pattern looks like, or broadening pattern. Look at this. It's almost identical to what we're seeing. See, we got 1, 2, 3 tests on the downside. 1, 2, 3 here. We have one, then a failed test to get even to that line. See how that correlates from here to here? Then we have a test of the line from here to here. And now look where we are, almost at the most extreme high on that broadening top. Now what does that mean? It means watch out below. So if it breaks out to the downside, we could see significantly lower lows. Now again, this is a broadening top that is based on a monthly chart. So if it goes all the way down to the bottom angle of that megaphone, as we call it, that could mean a significant drop in the down. Now look at the timing of this. This is going, if we broaden this out, and let's say we forecast and move it out to that level, we're going into 2022, which is now approaching the midterm elections. See how the timing of that is right there? Now I'm going to erase this, and I'm going to keep my lines on here so that even when we switch to a daily chart, we go back to that, at least we will know where these extreme levels are. All right, so again, my short-term forecast is that we pull back to fill the gap. The other thing I want to mention is that if we manage to break out over the top of that that broadening pattern, then of course we have a role reversal concept happening there where the former resistance could turn to support. And that's a whole different world if it breaks out to the upside. But for right now, I'm looking at the CCI going lower highs. I'm seeing the volume drop, and that is, of course, significant. So be careful. Make sure you're managing risk, particularly using the 1% rule. Now, if you like this video, please like it. I really appreciate it if you do that because it helps with the algorithm and getting this information out. Then please share it with people who you know could use the information, especially the shorter term traders, the swing traders and such. And if you want to get notified of the next alert when it comes out, just hit the subscribe button and then click on that notification bell. It will automatically notify you in your email box that an alert went out. So that's it. Have a great weekend, and we will talk to you soon. So long.